Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we're going to have a look at the latest non-farm payrolls print in the US. We'll have a look at what's happened to the dollar. We'll have a look at that decision from the ECB to cut rates. And finally, we'll look at the South African GDP numbers. We're going to start off with the dollar. Over the past month and 3 months, in fact, over the past year, we've seen quite sizable dollar weakness in response to elevated US trade policy uncertainty. And that's not what the consensus forecast was at the time. The general view was, should there be an increase in uncertainty globally or in the US, that would be met with some degree of dollar strength. So we've seen a bit of a surprise move in the dollar here. And of the currencies that we track, nearly all of them have strengthened against the dollar over the past month, and nearly all of them have strengthened over the past 3 months. If you stretch it out to 12 months, there's a collection that hasn't strengthened materially, but even so, there's a number of currencies that still actually are stronger on a 12-month basis too. Now, despite the recent weakness, the dollar is still strong. If you look at the trade-weighted, inflation-adjusted dollar, that is looking at the dollar compared to all of its peers, weighted appropriately, you can see that the dollar is still close to the strongest that it's been in the past 20 years, and in fact, close to the strongest it's been in the past 50 years. And on the opposite side of that, there's a number of currencies that are still quite weak. They're not the weakest they've been in the past 20 years. That was just a few months ago, but they're not far off that. So the dollar has weakened off very strong levels, but still remains at this point quite strong. And if we look at the latest high-frequency indicators with regards to global growth, and we get that from the PMI data across the globe, the latest data suggested that there was a mild uptick in economic activity last month across the globe, and that was led by the US. Now, what's interesting about that is if you scratch a little bit, there's a couple of underlying series that give us information around economic activity on a high-frequency basis, and at the moment, these series are diverging. You see some series suggesting that there was an uptick in economic activity and another series suggesting, which should be quite similar, but suggesting that actually there was a slowdown. The point out of this is that it's unclear at the moment what is actually happening on the ground in the US. We've got series which typically would tell us the same thing, telling us different things, and we need to wait a little bit to get clarity on the current economic impact of trade policy uncertainty. And we'll see a similar narrative when we look at the inflation data. There's something to add, though. What we do know from the PMI data in the US is that some of the tariff increases have been passed on already, and that tells us that we can expect to see some upward pressure to US CPI inflation. Now, in contrast, European inflation has declined. It's now below the central bank target of 2%, and that's allowed the ECB ample scope to cut, and they've cut 8 times over the past year. In the last meeting, they indicated that they were unclear that they'd be in a position to cut again. The market does expect one more cut over the coming year, so a lot of the work's been done already. Even so, we've seen this decline in inflation, as I said, down to 1.9%. Not all of that was just due to lower energy prices. We've actually seen a decline in services inflation in Europe too. And that's what led to these two very divergent paths. You know, the ECB, which has regularly cut over the past year or so, and the Fed, which has had to adopt a much more cautious approach given trade policy uncertainty in the US. And what's interesting to note that this dollar weakness happened in an environment where the Fed funds rate has been kept elevated relative to European rates. And again, the conventional view up until now is that higher interest rates in the US would have led to a stronger dollar. And that's not what happened. And that provides further evidence that currencies tend to take their cue from growth trajectories rather than simply interest rates. And what we have seen over the past few months is a quite sizable downward revision to US growth expectations, as European growth expectations have in some cases been flattened, actually in a couple of times over the past couple of months been revised up. Looking at the non-farm payrolls print, which came out on Friday, at first glance it was pretty good, 139,000 jobs added, relative to the consensus of 126,000. And if you look at the 3-month average, which is probably the right way to do it, given that the non-farm payroll series can be quite volatile, that was up to 135,000. So that's pretty good. But there were a couple of reasons for concern. As an example, the prior 2 months were revised down by a collective 95,000 jobs. And each of the past 4 months have been revised down, and the collective downward revision is over 200,000. In addition, the government continues to reduce its headcount, down 22,000 last month, down a collective 49,000 from December. And there were a few other reasons too that suggest that the labour market is now entering to a patch where it's likely to slow. And in fact, the consensus forecast is that job growth will slow over the next couple of months. And all of that is quite inconsistent with what the market is saying about the possibility of a recession. The market is pricing in, based on the betting market, about a 25% chance of recession. That's much lower than it was this time last year, where it was about 50%. Now, that is a bit difficult to reconcile. A slowing jobs market should lead to an increased probability of recession. And it does suggest that the market in aggregate is still quite sanguine about the possibility of a slowdown in the US. And that is still a concern for us, with the US market being on a forward PE of 22. Switching to South Africa, we had the GDP print come out for South Africa, a mild upward surprise. It came out at 0.1% quarter on quarter. The consensus forecast was that it would be minus 0.1%. There were a couple of concerning bits in that GDP print, though. The first is that nominal GDP growth was negative in the quarter because of very low levels of inflation. It's not often the case that you get negative nominal GDP growth in the quarter. In fact, it's only happened 5 times in the past 10 years in South Africa. Lower nominal GDP growth is a problem for company top lines. It's a problem for tax collection too. I'm going to see a lot of attention placed on that number. So the real number surprised on the upside, but the nominal number was quite weak. Real GDP is only 2% above pre-COVID levels, which were 5 years ago. We've gone through a very slow patch of GDP growth over the past 5 years. And even over the last year, if you look at the 4 quarters together, the South African economy grew by about 0.4%. The median growth across the globe was 2%, falling behind peers. And there does need to be a review of why the South African economy is growing as slowly as it is. In addition, while the inflation environment might make it an opportune time to change the inflation target, it does look like growth is pretty weak. And one wonders what will happen should it be the case the central bank target was 3% and we keep real rates very elevated. And that's where we're going to leave it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that I reference in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.